the jury is out on where Treasury yields go next. What do you expect tomorrow?
What we expect is interesting. The markets are not pricing in a big move tomorrow, given Warsh's speech. It's about 60 basis points in terms of plus or minus. So it's not a lot of expectations out of it. What I'll be looking for is, does he have commentary around his comfort with long-term yields at over 5%? And also, how is he thinking about inflation and the strength of the economy? Just recently, jobless claims have been at the low end of the range. PMI data has been very strong. The Philly Fed data has been at some of the highest levels in years. All of that is telling us the economy is strong. Inflation is here to stay. Yields are telling us that. It'll be interesting to see if we get any commentary from Warsh around any of those items.
It gets to this idea, though, too, when we talk about equity traders and how they're valuing stocks either on an individual basis or in aggregate. How much of a factor do you think current yield levels will be, and bets on what the direction is for those yields?
Yields are increasingly important. It used to be more about the bond market and how is the bond market thinking about them, but equities take note of what is the 10-year and what are 30-year yields doing. And we've been seeing those creep upward, mostly because for one good reason, which is a stronger economy, but one reason that that's not so great, which is that inflation is structural. And how will the Fed react to that? Will they raise rates, or will they be able to stay on pause? I don't think we have any cuts on the table, but what to watch there will be the employment markets, which have weakened. Now, of course, if employment markets continue to weaken and inflation stays structurally high, then we have to start thinking about stagflation. I'm not thinking that stagflation is going to be an issue yet, but that's another thing to watch. Employment markets, are they going to keep getting worse? And secondarily, will inflation stay structurally above target, which is where we are on inflation already.
So where in the equity market, then, is basically a good place for investors to hide out? Is it the mega cap tech stocks that have these strong balance sheets, that have this resilience, or is it maybe some more unloved parts of the equity market that haven't rallied yet?
But there's been three pressure points causing turmoil for the markets recently. That is yields, which we already discussed, higher oil prices, and of course, questions around the AI trade. Nvidia answered that question yesterday very boldly and dismantled the bears' case on AI. People had been worried about AI spending. They talked about spending on CapEx through 2028. And even more importantly, they raised revenue growth for fiscal 2027 to 70% when consensus was at about 45%. So that's very bullish for tech stocks. And we're seeing that today at the expense of everything else that's not technology. We're also seeing software recover. We'll see Workday report after the close today to see if that continues. But if software and hardware and semis are continuing to show the strong earnings numbers, I think tech will continue to lead from here, and that'll be what takes markets higher.
Hey, what about within credit markets? We had a guest on The Real Yield a little bit earlier today saying that the equity investors have fared well from AI, but the fixed income investors haven't. I think he said we've been a bust. AI has been a bust for fixed income investors. Is there opportunity now to come in where spreads are?
Well, spreads have been pretty tight recently, which has been a little bit challenging for fixed income markets. But of course, yields are high, so returns on fixed income you can still get pretty strong returns on fixed income. It's interesting, you are seeing AI creep into the credit markets, though, in terms of the types of credits that are available for fixed income investors. But the main beneficiary of the AI trade is the Mag 7 and the NASDAQ. That's where the earnings is, and that's why those are the companies that have been leading the markets higher on the equity side.
I do. It's kind of interesting. We talk about the Mag 7, but were you surprised at some of the results that we got out of some of the software makers? I know all the focus is on Nvidia today, but I mean, you have Salesforce up 20%. A lot of the other software makers that have reported over the last couple of weeks seem to have sort of, at least for now, put some of those fears about that SaaS apocalypse to rest. And as you said, we're going to hear from Workday and Autodesk after the bell tonight. Is it too soon to sort of make a call on that?
Well, there was so much noise around the impact of AI on software companies earlier this year, but really when you separate the signal from the noise, it didn't show up in software companies' fundamentals. Revenue growth rates for software companies remained fairly stable. Earnings have remained very strong, and so have margins. So we're not seeing it. I think it was just a lot of concern earlier this year. There was so much talk about how many jobs is AI going to eliminate. We're not really seeing that to a great degree at this point. And which sectors is AI going to replace? People were very concerned about about software. I don't think that's the case. So I think you will continue to see these companies rebound from the ashes.
Just real quickly, we're also going to get Marvell after the bell tonight. I am curious, anything to read from Nvidia's earnings into Marvell? I know not quite apples to apples, but there's got to be a connection.
My question will be, if Marvell earnings are strong, it'll tell us that the AI trade is more than Nvidia. It's broader than Nvidia. I would like to see that with strong Marvell earnings.